Okay. Bonjour à tout le monde. Malgré le fait que mon français n'est pas trop mal, je vais changer en anglais. Oui, good to be here again. Usually I talk why gold, but why gold has become obvious now. So even the not so smartest people in the world starting to look at gold. The dumb guys are still out of gold, so I'm happy about that because I know them, and when they come into gold, we will get nervous, but we are far away from that point. So interesting times ahead. So my focus tonight is why gold, Meier, why our product, and why now. So it jumps a bit around. So let me see that I already had troubles in Zurich. So here we start. Valuation. Gold miners are trading at the lowest valuation ever since we have data. Price cash flow 30-year low. Usually gold miners trade at a significant premium to the stock market. Now they are traded at a significant discount to the stock market. This is how bad it is, how bad our industry has gotten, or our track record, I would say, of the gold mining industry in the last 10 years have resulted in a massive de-rating. Now, I'm a deep contrarian investor like Claude, so we like that because that means you will make a lot of money going forward. Same on price book. After the recent correction, we are trading probably closer to 1.2 times right now, which is, except this near-death experience here in 2013, 14, 15, it's the lowest valuation, and the valuation where you have to go long, not the valuation where you have to get short. So really cheap. Interesting also if you look globally, there are actually gold miners discounting well over $2,000 gold. These are, first of all, the royalty companies, and secondly, the bigger Australian domestic producers, which are, by the way, hitting the wall, so they start to underperform. But if you look in Canada, in the rest of the world where our focus is, and also the focus of this conference, the producers are trading around 1,400 gold, so discounting a lower gold price than where we are right now. This is very unusual because at the start of a new bull market, gold miners tend to discount a higher gold price. Now they discount a lower gold price, never seen at the start of a new bull market. So very exciting times ahead of us. Another thing which speaks for gold miners and which will lead to big inflows into gold miners and gold mining funds in the next few years is this chart here, correlation. We have a big problem. People have realized in the world that we will live in a zero or negative interest rate environment for many years to come. Now, finally, we talked that to many guys years ago, and they didn't believe us. They said, no, interest rates will normalize, and we can buy bonds again, and the world will be fine. Now, I told them, this is bad news. Forget it. It will not happen. Now, they actually agree now with us. So the non-normalization of interest rates has come to investors' mind, but it has not yet come into investors' portfolio. So we are seeing the first small independent wealth manager having workshop of how should a future asset allocation look in a world of zero negative interest rates. And what's very clear, you have to go into real assets. You have to reduce your fixed income, your cash proportion of an asset allocation. And this tanker of asset allocation, which was kind of stable for the last 40 years, is now drifting into a new direction. And we are at the start of this drift, and it's important to get long this sector at the start of the drift, because in the end, when Credit Suisse, UBS, the big pension funds will incorporate lots more real assets into their asset allocation, it will be too late. And gold miners are the only equity part of this equity market which is non-correlating. So actually by increasing your equity ratio, which everyone will have to do in the next 5 to 10 years, you only have one asset which actually is quite correlated, which is gold miners. So good news ahead for us. Now, why should you invest in our fund? I usually do that very quickly, but this time we have a bit more time on that one, given I don't need to explain the gold case. Our fund has currently, on average, the holdings have a discount of over 40% than if you buy a gold mining ETF or an index. Now, in every sector, usually when you buy something which is value, and we are a value shop, you pay for it by lower growth. The insane situation in our sector is that you currently, if you buy the companies with growth, they are cheaper because they are the small caps, they are cheaper than the large caps. So the only correlation which works right now is the more mines you have, the higher valuation you have, and the more liquidity you have, the more valuation, the higher valuation you have. So this creates a huge opportunity for small caps, and we are kind of focusing on small caps in our fund. It's not a poor small cap fund, but it's a blend between large, mid, and small cap with a heavy weight into small caps. So you have all the good things, huge discount at better growth prospect. Very unique, very interesting. We also expect a major consolidation within the smaller cap names because they don't get access to capital. It's not that they won't, but the good thing is on our sector, more and more management teams are becoming 60 plus and they are finally ready to leave because that was one of the biggest obstacles to M&A in the past. And we had a case in the portfolio early this year where two miners, operating miners with one mine each, merged and the stock doubled within 6 months before gold took off, just because the company is now safer because they have two mines instead of one mine. It's ridiculous, but it's part of the situation we have to deal with. And the last point, ESG is becoming more and more important. When I joined the firm in 2012, my first project was looking at ESG. I was a bit ahead of the curve at that time, but now it is in everyone's mind. It's part of our investment process for many, many years. So what speaks for us as well is the performance, and we always say we are a kind of a Porsche, a Ferrari, whatever your preference is, or Tesla. Interesting is you want to have gold miners and our fund in a bull market. You don't want gold miners and our fund in a bear market. It's useless to have a gold mining fund in a bear market because you lose only 70%. With us, maybe you lose 80%. Doesn't make a big difference. You don't have to be in. Very important. So important is this side. We are back in a bull market. In the end of this bull market, the bars will look similarly. Our active competition, which has also small caps, are lagging big time, as we can see here. Despite our small cap tilt, we are outperforming the ETF significantly since the start in 16, and despite a pretty bad 18, where obviously the small caps were lagging big time when the sector turned around. On a yearly basis, our fund does in a bull market 50%, outperforms GDX by 15% per year. This is our most expensive retail class, by the way. In the long term, we did about 4 times. But it's shocking, you know, if you look, we are in the business for more than 20 years. This industry has been able to do 150% only. This is when you invest with the large caps, but I guess you don't, as we don't have large caps in this conference. So speaks for active management, speaks for some of the companies here. We don't like all of them, but I will not tell you which one we like, which one we don't. So I'm staying neutral. Why now? Gold is finally breaking out. We had very rough years in the last 6-7 years with this huge trading range. Finally, we were breaking out. So we are blessed because it has become time. It's been brutally frustrating. But the most interesting thing for me is the behavioral finance point of view, because I'm managing public mutual funds for 25 years now, and I can tell you the crowd is your best indicator. I can actually tell you even on a few times in the year, I get a few nervous emails within 3 days. I know that's the bottom. It was actually this week again. I got quite some nervous mails from investors. And I can tell you when we are at the peak. As an example, in February, within 3 days, I got 7 mails from investors of us. Are we breaking out? I said, no, we won't. So they were very disappointed. So, but here, when we broke out, I got 0 email from our clients. Are we breaking out? But the more interesting thing is what happened in the last 2.5 years. We saw many potential clients in this period when gold was consolidating, gold miners were doing even worse. And the people told me, Erich, yeah, I will buy your fund, but I wait for the breakout because I need instant performance. I said, yeah, I wish you good luck. I'm a value guy, so I buy always on consolidation like we have again now. But the interesting thing is, they said, can you please put me on a list and call me on the day of the breakout? Then I will buy your fund. So we made our list, as Swiss people are very, very conscious. I'm a very conscious guy, so very detailed. On the day of the breakout, 1370, we sent an email with that chart. Obviously, we didn't see that part yet. This is it. Finally, after years of frustration, we are here. We are breaking out. We have all the signals. We have a perfect macro monetary environment and technical environment for gold now to break out. So we called each of them. There were 20 names. And I said to myself, because I'm heavily long this sector, if 10 or more buy, it will be a false breakout, just because of my personal experience as a fund manager of public funds. So I will decide what I do with my personal position, if I trim a little bit on a breakout or not. But the interesting thing is, of the 20, not one single one bought. So I can guarantee you, I added here on the breakout, here again, I'm adding what I can. People don't believe it. This is the most bullish signal. And it's not only with our fund. If you look at ETF, GDX, GDXJ, 16% outflows year to date, despite being one of the best performing sector or theme in the S&P, in the stock market. Physical, we have inflows. Now the difference to 16 is in 16 people were jumping on the minus and got burned because we had a 2-year consolidation following this 16 breakout. Now people don't believe in it. This is why it's real now. It wasn't in 16. Very important. So very bullish signs. And what's important, we meet so many potential investors, and everyone tells us, yeah, we are in physical, but the minus, yeah, maybe later. The problem with these investors are that we know it ourselves. You have to buy the gold miners in the initial phase of a bull market. In the first few years, they outperform physical gold by a factor of 5 to 10 times. Later in the cycle, it's 2 to 3 times. In the very latest part of a bull market, they actually underperform physical gold. This is when the crowd comes in. It's a shame. So risk reward, it's in the first few years. We are pitching that, but people don't want to listen, which is bullish in the end. So another good thing, we have another good news coming from earnings revision. We had this sector, this theme is now the best performing, or based on financial metrics. We see the highest increases in return on assets, return on investments, higher free cash flows, with the exception of the Australians. But very interesting things. All the quant guys will start buying our sector. What's also good in Canada, where gold miners have been dropping out of the indices in the last few years, now in every index revision, 3 to 7 gold miners come back into the theme. That increases the buying from the passive side. But even more interesting is the active guys in Canada have a big problem as well. The active fund manager generalist in Canada is heavily underweight gold miners because this sector has been a disaster for the last few years. So they run at 2 to 3% weights on average we hear, while the benchmark is closer to 10. So heavy underweight, no problem if the sector continues to drag, but becomes a big career risk if the sector continues to outperform. With the inclusion of these new smaller mid-caps into the index, their underweight gets bigger. With the outperformance of gold miners, the underweight gets bigger, and the risk of losing their job becomes bigger as well. So they will buy. So I always say, as frustrating the last few years were for us, for gold mining investors, the crazy bullishness we will see in the next few years, we all know that. We have experienced that before. We were shaking the head on the way down, how this sector was depressed. We will shake our head how it will go up, I guarantee you. So this is the most important chart. You buy in the early start of a bull market, don't buy in the last part. You see, you don't necessarily need to go into micro caps. to make 10 times your money. Our fund does it as well, and you are well diversified, and the companies are tracked by a technical team out of Vancouver. So it's getting red, so I'm getting to finish. I'm perfectly on time. So perfect time for gold miners, perfect time for our fund, perfect time for gold. Be long, buy as soon as possible, because the later you buy, the more you will pay. So that was it. Do you have questions? I don't know if you have 1 minute for one question or so. Otherwise, I'm still around until around 1 o'clock if someone wants to contact me. Perfect. Okay, thanks a lot.